Hello everybody, my name's Tom Sheridan from Seven Investment Management, and what I'd like to do today is talk a little bit about the 7IM funds and the progress that we've made within 7IM over the last few years. Now, for those of you who don't know us, what we're trying to do is to accomplish three rather straightforward objectives. Number one, we'd like an investment management program that has less than average risk, has less than average cost, and has a little bit better than average performance. Well, wouldn't everybody, you would say? Well, sure they would. However, the way that we do that is we think that the cost and the performance are interrelated, particularly in a world where we're looking forward to potentially lower returns from the investment portfolios themselves. So if you had two portfolios, both with equal levels of risk, and one of them cost less, well, which one is going to perform better? The one with the lower cost, of course. The way we go about that is we have a starting position, or what we call a strategic asset allocation, which is an asset array for four different levels of risk, which is based upon historical performance of the asset classes. In fact, these strategic asset allocations, as we call them, represent almost ideal portfolios for the given levels of risk for yesterday, but not necessarily for tomorrow. So therefore, we superimpose on that the strategic asset allocation, which is a view taken by the 7IM Asset Allocation Committee as to what it is that we're looking at in the outside world, in markets, and how to apply that to the strategic asset allocations. So we tilt them a little bit more conservatively or a little bit more aggressively, depending upon the view of the Asset Allocation Committee. You can see here in this slide that for the four different levels of risk represented by the columns, that each one of them down the bottom has an expected return and a standard deviation. The standard deviation is a measure of risk. The bigger that number, the more risk in the portfolio. What we're trying to do is we're trying to achieve, over the course of time, the expected levels of return with as little risk as is. Each member of this committee, on average, has been managing money for about 27 years each. So you need a few wrinkles and gray hairs, or perhaps no hairs, to get into the committee. However, we have a number of current or former chief investment officers in the committee, and each member has a different area of expertise. So we have one with emerging markets expertise, one with fixed interest, one with property, one with currencies, etc. And we have a few generalists in there as well. You can see the level of diversification here in this slide. This is a much more broadly diversified portfolio than is normal for the retail world. And it is this degree of diversification that provides the lower level of volatility or the risk. So long story short, what we've been trying to do is to provide a little bit better than average performance for less than average risk and less than average costs. And I think we've done the first one, I think we've done the second one, and I think we've done the third one. Thank you very much for your time and attention.